You've been saving for 5 years. You finally find it, a modest house with a small yard. You offer $20,000 over the asking price. 2 hours later, your agent calls. You lost. The winner, a multi-billion-dollar investment fund that paid all cash, waived the inspection, and closed in 48 hours without ever stepping foot on the property. You aren't competing with other families anymore. You're competing with a supercomputer in a Manhattan skyscraper that decided your neighborhood is the perfect place to extract recurring revenue for the next 30 years. Welcome to the era where you don't buy a home, you subscribe to one. 5. The analysis, the core content, the institutional invasion. Since the 2008 crash, a new predator has entered the housing market, the institutional landlord. These aren't mom and pop investors with 2 properties. These are firms managing hundreds of billions of dollars. They realize that in an unstable world, people will always need a roof over their heads. By vacuuming up the supply of single-family homes, they've turned a basic human necessity into a high-yield financial instrument. The algorithm advantage. These corporations use sophisticated AI software, like RealPage, to track rental demand and set prices. In many cases, these algorithms suggest raising rents even when vacancies are high, effectively price-fixing entire cities. They aren't looking for a fair price. They are looking for the maximum pain point a tenant can endure before moving out. The build-to-rent revolution. The most disturbing trend in 2026 is the rise of entire neighborhoods built specifically not to be sold. Developers are partnering with private equity to create build-to-rent communities. Every house, every blade of grass, and every street lamp is owned by one corporation. You get the manicured lawn and the 2-car garage, but you never get the deed. You are a permanent tenant, paying off someone else's corporate bonds while your own net worth stays at 0. The death of generational wealth. Home equity has historically been the #1 way the American middle class built wealth and passed it to their children. By shifting the nation toward a rentership model, Wall Street is effectively siphoning the primary wealth-building tool away from the public. This isn't just a housing crisis, it's a permanent wealth transfer from the many to the few. The institutional squeeze and the managed shortage. The scarcity in the housing market isn't just an accident, it's a feature. By controlling a significant percentage of starter homes in specific zip codes, corporate landlords create a local monopoly. When one company owns 300 houses in a single suburb, they don't just follow the market, they are the market. If you try to find a cheaper place across the street, you realize the same entity owns that one too. This is the financialization of shelter, where the value of a house is no longer determined by its utility as a home, but by its ability to generate a 7% annual return for shareholders. The maintenance mirage. When a corporation is your landlord, you are no longer a tenant. You are a user. Maintenance is outsourced to third-party contractors, and every repair is a battle against a bottom line. Because these firms operate at such a massive scale, they can afford to leave a house empty for months rather than lower the rent, because lowering the rent for one person would lower the asset value of their entire portfolio on paper. They are playing a game of real estate chess while the average family is just trying to find a place to park their car. The erasure of the middle class. The traditional economic ladder in America had 3 main rungs: education, a stable job, and homeownership. We've already seen how the student debt loop broke the first rung. Now, corporate landlords are sawmilling the third. Without the ability to lock in a monthly mortgage payment, the American worker is at the mercy of perpetual rent inflation. While a mortgage stays the same for 30 years, rent can go up 10% every year. This ensures that no matter how hard you work or how many raises you get, the cost of existing will always rise to swallow your surplus. The 2026 ghost town effect. As we move further into 2026, we are seeing the rise of ghost suburbs, beautifully manicured neighborhoods where no one actually owns anything. There is no sense of community because everyone is transient. People don't paint their front doors or plant gardens because they know their lease might not be renewed if a higher-paying tenant comes along. This is the commodification of the community. We are trading the soul of our neighborhoods for the efficiency of a balance sheet, and the cost of that trade is the stability of the American family. The final outlook, the new serfdom. We are heading toward a two-tier society, the asset class and the renter class. In this new feudalism, the lords aren't people with titles. They are faceless investment funds with tickers on the NYSE. The serfs are the working professionals who spend 50% of their income to live in a house they will never own, in a town they can't afford, working for a future that doesn't belong to them. The American dream didn't disappear. It was simply bought out, renovated, and put back on the market at a price you can't afford.